How the wealthy use credit to build borrowing power. If you're still treating credit cards as simple payment tools, you're leaving 6 figures of liquidity advantage on the table over the next decade. This video deconstructs the institutional framework that wealth advisors use to position credit as a core component of capital efficiency strategy. The same analysis that typically costs between $1,500 and $3,000 USD in consultation fees. By the end of this presentation, you will understand how to architect credit positioning to optimize tax timing windows, how to structure liability separation across personal and entity frameworks, how credit utilization mathematics directly impacts your future borrowing capacity, and how float periods function as zero-cost working capital. Before we dive in, some ads may appear during the video. Your support allows this channel to keep sharing valuable information for free. Now let's dive in. You will want to take notes because what I'm presenting here is the exact capital allocation framework that institutional wealth management firms use when advising clients with portfolios exceeding $2 million USD. And most business owners miss these mechanics entirely, which costs them compounding advantages year after year. Let's begin with what I call the credit as liquidity architecture principle, because this reframes everything. When sophisticated investors evaluate credit products, they're asking how this instrument fits into their broader capital structure. Think of your available credit as a liquidity reserve that sits alongside your emergency fund and securities-backed lines of credit. This isn't money you plan to borrow long-term, but it represents deployable capital that can bridge timing gaps without forcing you to liquidate investments at unfavorable moments. Here's why this matters practically. Imagine you're a business owner and a strategic acquisition opportunity emerges in November, but your quarterly distributions don't arrive until January, and selling appreciated securities now would trigger short-term capital gains taxed at ordinary income rates rather than long-term rates. The ability to deploy credit for 60 to 90 days represents what institutional investors call temporal arbitrage. You're optimizing the timing of capital movements to minimize friction costs. The temporal arbitrage mechanics that I just referenced depend entirely on having the right credit infrastructure in place before you need it. This is the first major mistake I see repeatedly. People apply for credit products reactively when they're already under capital pressure, which typically results in suboptimal approval terms because the application itself signals financial stress to underwriting algorithms. The institutional approach is the opposite. You build credit capacity during periods of strong cash flow specifically, so it's available when timing opportunities emerge. Now let me address entity structuring, because this is where substantial strategic advantage compounds. The liability separation strategy involves establishing true business credit under an entity EIN rather than your social security number. This requires an entity structure that files its own tax return, an S corporation, C corporation, or multi-member LLC taxed as a partnership. Once established, you build business credit history through net 30 vendor accounts, then progress to business credit cards that report to commercial bureaus like Dun & Bradstreet rather than consumer bureaus. The result is that your business expenses sit on an entirely separate credit profile, your personal utilization ratios remain low, and you've created meaningful liability separation that strengthens your overall risk architecture. Let's talk about the cost of capital analysis framework, because this determines when credit makes sense versus alternative funding sources. Premium credit cards with extended float periods, typically 45 to 55 days from transaction to payment due date, represent zero-cost borrowing during that window. Compare this to withdrawing from a brokerage account holding appreciated securities, which might trigger 15 to 20% in capital gains taxes in USD, or taking a securities-backed line of credit that charges 4 to 6% annually. The institutional framework asks, what's the after-tax cost of each capital source, and which source optimizes for both immediate cost and strategic flexibility? The framework isn't about always using credit or never using credit. It's about having the analytical structure to make optimal decisions in each specific context. Now we need to examine utilization ratio mathematics, because this single metric has outsized impact on your creditworthiness. Your credit utilization is calculated both per card and across all revolving credit, and the scoring models penalize high utilization even if you pay in full every month. If you have 3 credit cards each with a 10,000 USD limit, and you run 8,000 USD monthly through one card, you're showing roughly 80% utilization on that individual card, even though your overall utilization is only about 27%. The scoring models heavily weight that per card ratio. The sophisticated approach involves distributing spending across multiple cards to keep each individual card below 10% utilization while maintaining overall portfolio utilization below 20%, or requesting credit limit increases annually to expand your denominator without increasing your numerator. The tax timing windows concept deserves careful attention because credit serves as a bridge tool that helps you optimize when you realize taxable events. If you receive a substantial bonus in December that pushes you into a higher marginal tax bracket, and you have major deductible expenses coming in January, you could potentially accelerate those purchases into December using credit, then pay the credit card bill with your January cash flow. This effectively pulls deductible expenses into the higher income tax year, maximizing the value of those deductions. I need to be clear here. I'm describing the mechanical framework, not providing tax advice. The IRS has specific rules about timing of deductions. You absolutely must work with a qualified tax professional before implementing any tax timing strategy. Let's address future borrowing capacity because your credit positioning today directly determines what's available tomorrow. When you apply for a mortgage, the underwriting process examines your debt-to-income ratio, which includes minimum payments on all credit cards, even if you pay them in full monthly. A 500 USD minimum payment might reduce your mortgage approval amount by roughly 100,000 USD, depending on current interest rates and debt-to-income thresholds. The institutional approach involves strategically managing credit in the 12 to 24 months before any major borrowing need. This means keeping utilization minimal, avoiding new credit applications that generate hard inquiries, and potentially paying down installment loans to improve your debt profile. Float period optimization represents one of the most overlooked strategic advantages. The float period is the time between when you make a purchase and when you must pay for it without incurring interest charges. With proper timing, you can extend this to nearly 2 full billing cycles by making purchases immediately after your statement closes, giving you 55 days of zero-cost financing. For business owners with predictable large expenses, this float effectively functions as working capital. If you're running 50,000 USD monthly through credit cards with optimized float, you're essentially operating with an additional 25,000 to 30,000 USD in working capital that never shows as a liability on your balance sheet because you're paying before interest accrues. The risk mitigation framework aspect of premium credit deserves attention because credit cards offer liability protections that cash and debit transactions don't provide. When you make a purchase with a credit card, you're creating a buffer between your bank account and the merchant. If there's a dispute, you have the card issuer's dispute resolution process working on your behalf. And importantly, the money hasn't yet left your account. Additionally, many premium credit products include extended warranty protection, purchase protection against theft or damage, and travel protections. These benefits have real economic value. I've seen business owners save thousands in USD by using the extended warranty benefit when equipment failed just outside the manufacturer's warranty period. Now let's examine entity credit building, because this is where business owners can create substantial long-term advantage. Building business credit under your entity EIN requires a methodical approach. You begin with vendor accounts that report to commercial credit bureaus. Companies like Uline or Granger that offer net 30 terms. You make on-time payments for 6 to 12 months, establishing a payment history that commercial credit bureaus track. Once you have several vendor trade lines reporting, you can approach business credit card issuers. Initially, these will require personal guarantees, but after 12 to 24 months of responsible usage, some issuers will remove the personal guarantee requirement. The strategic value is profound. You're building credit capacity that doesn't impact your personal credit profile or consume your personal debt-to-income ratio for mortgage qualification. The Capital Efficiency Metrics Framework asks a fundamental question. How much productive output are you generating per dollar of capital deployed? If you're using personal cash flow to fund business expenses, you're potentially leaving investment capital sitting uninvested while you wait to rebuild cash reserves. If instead you're using business credit with net 30 to net 60 terms, that same cash remains deployed in investment accounts for an additional 30 to 60 days, generating returns while your business expenses are functionally pre-financed. Suppose your business averages $30,000 USD monthly in operational expenses. If you're running these through credit cards with 45 to 55-day float periods, you're operating with roughly $45,000 to $60,000 USD less cash that needs to remain immediately accessible. That differential capital can be deployed in higher yield vehicles or kept invested in your core business operations where it might generate substantially higher returns. The liquidity reserve strategy concept positions credit as one component of a multi-layered liquidity approach. Institutional investors maintain liquidity in tiers: immediate cash in checking, short-term reserves in money market funds, medium-term reserves in securities-backed lines or business credit facilities, and only then do they access longer-term investment capital. Premium credit with low utilization and high available limits sits in that medium-term reserve category. This structure means you're not forced into binary decisions where you either liquidate investments at unfavorable times or miss opportunities due to temporary capital constraints. A 30-day timing gap might be best served by credit card float. A 6-month capital need might justify a securities-backed line of credit at low interest rates. Debt-to-income management becomes critical when planning any major borrowing event. Lenders calculate your debt-to-income ratio by dividing all monthly debt obligations by gross monthly income, and most have maximum thresholds, typically 43 to 50% for conventional mortgages in the USD market. Every credit card minimum payment counts against this ratio. If you know you'll be applying for a mortgage in the next 12 months, you want to minimize reported obligations during that window. Conversely, if you just closed on a home and won't need major borrowing for several years, that's the optimal time to strategically use credit for business expansion because your debt-to-income ratio isn't under immediate scrutiny. The interest cost avoidance framework recognizes that credit's primary strategic value comes from using it as a zero-cost tool through grace periods, not from carrying balances at 15 to 25% APR. The institutional approach treats interest charges as a failure of planning, except in carefully considered situations where the return on deployed capital substantially exceeds the interest cost. This means your credit strategy must integrate with your cash flow forecasting. You need visibility into when revenue arrives and when major expenses are due, so you're consistently paying statement balances in full. For business owners, this often involves maintaining a rolling 90-day cash flow forecast. The business versus personal separation principle extends beyond liability protection into tax compliance and audit risk mitigation. By running business expenses through business credit accounts rather than personal cards, you're creating a clear audit trail that demonstrates legitimate business use. This documentation becomes invaluable if you ever face examination of your business deductions. Moreover, this separation simplifies accounting substantially. Clean separation means your bookkeeper can automatically categorize business credit accounts as business expenses without review, which reduces professional accounting fees or internal time spent on bookkeeping. Cash flow smoothing through strategic credit usage addresses one of the most common challenges business owners face. Revenue arrives irregularly while expenses occur consistently. Credit serves as a bridge that smooths the timing mismatch between income and obligations. This is particularly valuable for maintaining your personal draw at consistent levels even when business revenue fluctuates, which supports better household financial planning and can improve your personal credit profile by showing stable income to underwriters. Let me explain approval optimization timing, because when you apply for credit matters significantly. Credit card issuers examine your recent credit behavior intensely. They're looking at your utilization trends over the past 3 to 6 months and your recent inquiry history. If you apply when these metrics are temporarily unfavorable, you might get denied or approved for lower limits despite having strong long-term credit fundamentals. The sophisticated approach involves strategic timing around the credit cycle. If you're planning to apply for new credit, you'd ideally want low utilization reporting on all current accounts and no recent hard inquiries. This might mean waiting until after you've paid down current balances, or delaying an application by 60 days so previous inquiries age off the 6-month window that issuers scrutinize most carefully. I want to touch on geographic arbitrage considerations for those operating across USD, CAD, and GBP markets. Foreign transaction fees on credit cards can erode 2 to 3% of transaction value, which means selecting no foreign transaction fee cards for international spending is not optional. It's a direct bottom-line impact. Additionally, if you're building credit history in multiple countries, you need parallel credit building strategies in each market because credit histories generally don't transfer between countries. A perfect credit history in the United States doesn't help you qualify for a mortgage in the United Kingdom. Before we end, let me summarize these critical insights. First, position credit as liquidity architecture rather than transactional convenience. It's a capital tool that provides temporal flexibility for optimizing tax timing and preserving invested capital. Second, implement liability separation between personal and business credit by building entity credit under your EIN, which creates asset protection and establishes independent business creditworthiness. Third, understand that utilization ratio mathematics drive creditworthiness. Distribute spending to keep individual card utilization below 10% and portfolio utilization below 20%. Fourth, Recognize that your credit positioning today directly determines your future borrowing capacity. Optimization must happen 12 to 24 months before major borrowing needs, not reactively. Here's the strategic positioning verdict. Premium credit creates substantial value when integrated into broader capital efficiency strategy and managed with institutional discipline, but creates meaningful harm when used reactively without understanding the underlying mechanics. The business owners who build credit capacity during strong cash flow periods, maintain clean entity separation, optimize utilization through distribution and limit management, and treat credit as zero-cost liquidity through float periods. Those individuals are compounding advantages that accumulate into six-figure differentials over a decade. The final calculation framework asks you to quantify these advantages in your specific situation. If optimizing float periods preserves an additional $40,000 in working capital earning 5%, that's $2,000 annually. If maintaining low utilization means qualifying for an additional $100,000 in mortgage borrowing capacity, and that allows you to purchase a property that appreciates 5% annually, that's $5,000 in year one equity appreciation alone. These advantages compound year after year, creating structural financial resilience that most business owners never build. Subscribe for institutional-grade financial analysis that translates complex wealth management frameworks into implementable strategy. Like this video if it fundamentally changed how you think about credit positioning. Comment with your specific questions about how these frameworks apply to your business structure, and I'll address the most common questions in future content. I am not your financial advisor. This content is for educational purposes only and does not constitute financial, tax, or legal advice. Consult with qualified financial advisors, tax professionals, and legal counsel before implementing any strategy discussed in this presentation. Individual results will vary based on your specific circumstances.